Hi everyone, my name's Darryl Panes, CEO at As Good as Gold Australia, and this evening once again I'm joined by my brother Brian.
How you doing?
And partner at As Good as Gold. And this evening we interview the founder and managing director of Matterhorn Asset Management and GoldSwitzerland, or refer of course to the legendary Egon von Greyerz. Good evening, Egon.
Darryl and Brian, good to see you again. Always a pleasure to talk to you. Good morning
Thank you
to
very
you.
much.
Yeah, I cannot believe it, Egon, that, and I keep saying this with a lot of people that we have interviewed, but we haven't had an interview with you for 12 months. I said to Jared earlier today, can you just check that? And we did. And I went back to that interview and sure enough, it was 12 months ago. So it is amazing how quickly time moves, and the older you get, the quicker it seems to move.
I thought you were going to say how quickly I've aged, but
no, not at all. we want to interview you again, Egon. That wouldn't get me very far. So, look, a lot. It goes without saying, Egon. A lot's happened in that period of time over that 12 months. A list of things that I could highlight. COVID-19, of course, has ravaged the entire world with a devastating impact on the economy. Debt levels are exploding. Stock markets have recorded all-time highs. Real estate prices are in a major bubble territory. Interest rates are at all-time lows, and massive destruction of currency all around the world continues. People are spending like there's no tomorrow. This reminds me very much of everything that I have ever heard and read and researched about the Roaring Twenties, and as if it's never going to end. This euphoria, spending euphoria, and we know what happened. Of course, at the end of the Roaring Twenties, we ended up with the Great Depression. And that lasted for many, many years. So I guess the question right now, I've got a lot of questions, but the question I'd like to ask you right now is, how long can this continue? And what do you think is going to be responsible for bringing down this house of cards?
that's an excellent
Oh, yes, I know.
question. How we can talk a lot about that particular point.
Yeah, of course.
And I will happily admit that I've been wrong on the duration of this incredible bull market, and I've underestimated the willingness of the world to believe that trillions and tens of trillions of printed money and credit actually is real money, and therefore we are living now with the emperor's new clothes, and nobody has said he actually hasn't got any clothes. So we went into gold in a serious way for ourselves and our investors in 2002, beginning of 2002, when it was $300. And we haven't changed our mind since. And of course, we had a big run up into 2011-12, and then we've had a few years of sideways. But I just published a chart on this on King World News now, but yesterday which shows it's an annual chart of gold and in US dollars, and it's very interesting because it shows you what a tremendous strong uptrend this is. So gold went up from 2000 to 2012, 12 years in a row. It closed higher. Then it only went down for 3 years, from 13 to 15. So only closing down for 3 years, 13 to 15. And now since 16, we've closed up every year, except 1 year was just $20 lower. But we closed up every year again between 16 and 20. So this is an incredibly strong uptrend. And so out of 20 years, gold has closed up for 17 years. So therefore, we went into gold, as I said, early this century. And the fact that the markets the bubbles are getting bigger, it is obviously only due to massive money printing. And this, as we both have been saying for years, of course, this is not real money. I mean, MMT is a con. an absolute con. Modern monetary theory, which is basically the same as Keynesian theories. And the world will discover that all this printed money, when this ends, will have zero value. Now, coming back to the roaring 20s, yes, of course, at the end of every bubble, there is uber optimism. There always is. People that, you can take all these quotes from the papers in the late 20s, 28, 29, where every person, politician, economist declares as this is going to go on forever. And that euphoria we have today. But exactly the same. But this is a lot worse than the 1920s when it comes to bubble. That was one country, especially the US. Europe certainly didn't suffer anywhere near as much in the 30s as the US did. And still, if you take the US, the debts and the deficits were nowhere near as big as they are today. The currency wasn't was weak either. So you're talking about a totally different picture now. And you're talking about a global picture also. That's never happened before in history. So nobody knows how this is going to end. We can all speculate, which we're doing, of course, all of us in our, in our interviews, in our articles. But nevertheless, when you had a country like Argentina or small countries, Weimer Republic, for example, other countries in the world could write off the debts and or help the country in question, depending on the political situation. And banks wrote off their debts, but that was affordable because relatively small in relation to the world economy. Now you're talking about US, Europe, China, Japan, emerging markets. They're all in the same situation with massive debts, living above their means. So when this bubble bursts, it will be so much bigger than the world has ever experienced. Therefore, we don't even know what the consequences will be. I mean, if you extrapolate that, it looks very, very dire. And I write about this and talk about this often. I don't want to be a pessimist, as you know. I mean, of course, I love life. I'm an optimistic person, but nevertheless, we're here to evaluate risk, and the risk is greater than anywhere, any time in history. But so coming back to your question, how long will this last? It's lasted longer than I expected, but that, when bubbles get bigger, it doesn't mean that they will expand forever. There is an end to it because, and I think, I see now that I think the stock market, if you look at the US stock market, is actually, because it's all about psychology, there's still, all the money is fake money. It has no value. So that from a point of view of money and solvency, etc., the world is insolvent. The US is insolvent. Most countries are insolvent. And they're just living on debt and credit. Most individuals are insolvent also. Only because of zero interest rates or very low interest rate can they still afford to borrow a lot of money, and the world can afford it. But really, so the world is insolvent. So we're really looking at here more, what ends this is more psychology than the financial position, because the financial position is already as dire as it could ever be. And that the world will only discover when it turns. So the psychology will turn probably with stock markets. It could also be with a banking crisis, like the Archegos case that maybe we'll talk about later. But nevertheless, so I think stock markets are very near a top. Whether very near means in April or in May, I don't know, and there's no use putting a timeline. But I think that and once that turns, I think that the whole the euphoria will turn, and then of course interest rates are already on their way up. The fact that the 10-year US Treasury has gone from 0.5% to 1.7 is 1.60 something now. But nevertheless, interest rates, the world cannot afford higher interest rates. But my view has always been that central banks will lose control of interest rates. You can't have record borrowing of 300 trillion in the world, and record low interest rates. It doesn't rhyme, these two elements. If you have high borrowings, you have high interest rate, because if the demand for something is high, then the cost of it should be high. But interest is only low because central banks are manipulating it. And borrowings are only high because interest rates are low. So, it's an absurd situation now, which cannot last. And central banks will lose control, first of all, of the long rates. And you see that on the 10-year already. They can keep the short rates low, but the long rates, they will lose control of it. And I think, the higher interest rates will kill this world. And that's going to come, because in the end, people will dump the bonds. And when the bonds are dumped, the interest rates will go up. And, I think eventually we will have a situation like I experienced in the 1970s in the UK, which was similar in the US, where inflation was 15 to 18% for about 7 years running in the UK. And as I often pointed out, my first mortgage in 1973-4, my interest rate went up to 21% on that for a while. How many people could live with 21% interest today? Nobody. Because people can't, people in Switzerland borrow 15-year fixed money at 1%. And in a lot of European countries, you can borrow also at under 2%. Anybody can borrow a mortgage, for example. And I mean that's just, they're buying houses at a level that they can't afford to service when we get back to proper market rates again.
Of course.
So that's what my view is, that we are near a turn in markets. But, the way I look at it anyway, it doesn't matter, because, then forecasting is a mug's game, and you will be more wrong than right on especially exact timing. You're asking when, it's much more, and then you say he was wrong again. But I'm much more interested in the direction and the risk than the exact timing of this. As far as I'm concerned, nobody who wants to protect their wealth should be in stocks today, or in bonds, or speculate in property. Owning your own property that you can afford is another matter, but you shouldn't have speculate and buy expensive properties today, because that they are in a bubble too. So I'm more interested in protecting the risk and being ready for, and not worrying about the fact that Tesla goes up, or Amazon goes up, or Bitcoin goes up. I'm more interested in helping our clients and ourselves to preserve our wealth and be ready for, the biggest risk that the world has ever experienced in history. That's what people got to be prepared for. As you know, only 0.5% of world financial assets are invested in gold. So most people don't listen to us, don't believe us, don't understand gold, because the press and governments and central banks, everybody, they don't understand gold either, because a high gold price to them actually shows that their mismanagement of the economy. So therefore, they want to suppress gold, and they don't really want to talk about gold. And therefore, most people or bankers or advisors don't either suggest gold to investors. Advisors, of course, because they can't make enough money on it. But nevertheless, that's what people should focus on. Yeah, that's right. They can't. You say, the thing is, any money manager wants to churn commission. It's immoral, but that's the way the world works. So, but therefore, we are a small group of 0.5% of the world that are into gold, and then silver is as small as that, even much smaller than that. So, and we are trying, as good as Gold Australia, ourselves, GoldSwitzerland, Matterhorn Asset Management, we're trying to help a few people to preserve their wealth. I think, that is the most important thing in financial markets you can do today. I mean, this is the most critical period in history, as I said. So that's more important than thinking, when is it going to turn tomorrow or the day after? But I think that we are near a turn, but I don't worry about it. We've been into gold for 19 years now, and we've never changed our mind.
No.
And we never changed. We never sold any gold ever, and therefore, I'm not. So this is a long-term game, and it's been tremendous investment. Also, if you started early, I mean, it's been a very good investment. But we are not in it for investment. We're in it for wealth preservation. But it will become a fantastic investment too in coming years, in my view.
Yeah, like what I have found, and it's surprised me, is the amount of intelligent people out there. Well, I would think I know these people, and just a simple case, like look at a market like the real estate market, and projections at the moment from the experts, Egon, are suggesting that over the next 1 year, 2 years, 3 years, they're forecasting years ahead, we can expect to see a 15% increase per annum in property values. Now, you've only got to do your sums a little bit here. Our wage growth is almost zero. It's under 1%, real wage growth in Australia. I suspect it would be similar in most parts of the world. You've only got to do your sums there and just say, well, okay, property values are increasing at the rate of 15% per annum, but real wage growth 1% or less. How on earth are these properties going to be affordable? And as you've just said, once we see elevated interest rates, then it's ball game over. And yet, so I can now see why in the roaring 20s, why it happened, how it happened, and how it led to the Great Depression. I just see the same thing happening all over again, which is indeed a shame. But question. I read an article by Matthew Piepenburg, of course, and he's a really smart guy, isn't he? But he was talking about derivative market, and I just want to make reference to a couple of his comments. He said, well, while all of this chaos is going on, what's going unnoticed and unreported is a 1.5 quadrillion derivative trade. It just keeps ticking over, and it's like a time bomb ready to explode. He said in the case of Deutsche Bank, his overall balance sheet asset valuation last year was around $800 billion. The ledger regarding its net derivative exposure was a measly $1 billion. 1 billion with a B. But they neglected to report the gross derivative exposure of $40 trillion. That's greater than 3 times GDP for the entire European Union. I mean, how long could this continue before that just collapses? I mean, surely that can't continue a lot longer.
The Deutsche is one of the worst, of course, and I've written about it also. And actually, in my latest article, I pointed it out again, this whole debt situation of the world, including derivatives. But they're not untypical. I mean, the JP Morgan and Goldman Sachs, Morgan Stanley, all of these big investment banks have similar size derivative position. If you let's take another figure instead of he's comparing it. Matt Piepenburg, he works with us, Matterhorn Asset Management.
Yes,
so he's one of us. But as you say, he writes very well. But if you look at the share capital of Deutsche Bank, the total equity is something like 60 billion against, let's say, 40 trillion derivatives. So you're talking about less than 0.2%. The capital is less than 2% of their gross outstanding derivative position. So basically all they need to do is to lose 0.2% of their capital on their position, and they've lost all their capital. And if they lose 0.5% or 1%, they're clearly insolvent. Now, of course, or they will say, like all the central bankers and the BIS, Bank of International Settlement in Basel, the central bank of central banks, they will all say, well, that's just the gross position. The net position is totally different because I think Deutsche Bank nets their whole 40 trillion derivatives down to risk of 20 billion or something. But you see, this presupposes that counterparty will stand there and pay up when something happens.
Yeah.
But we know when there's a crisis, the crisis happens, and banks fail and the system fails because the counterparty doesn't pay. Counterparty fails. Counterparty can't afford to pay up the whatever they owe. And that's so in that situation, the gross position remains gross. And that's why, as measuring risk, we've got to look at the gross. Obviously, when banks like Morgan Stanley, JP Morgan, or Credit Suisse give credit lines on their prime brokerage to hedge funds like Archegos and others, they're looking at they're all their risk. They're telling their risk, or the risk managers are telling the traders are telling the risk manager, and the risk managers are telling the board, and the board doesn't, on top management, doesn't understand anything of these positions. But they're telling them all that the net is only this, and this is why they can grant such ludicrous amounts of tens of billions or hundreds of billions to hedge funds to speculate on a massive leverage, and this is why the whole system is sick, totally sick. And as I said, uber leverage to an extent that the world, of course, can never afford to settle when trouble start. So yes, Deutsche Bank, all of the banks are overexposed to an extent that when confidence turns, the whole of the derivatives bubble is just going to implode at some point. And of course, that is something that the world cannot afford to deal with. They will deal with it in the same way as it always has, printing money. But, and if you said, my latest article shows, derivatives of 1.5 trillion. By the way, the Bank of International Settlement about 10 years ago, whatever it was, changed the calculation. They had also 1.5 trillion, and they netted it off to 1 to 600 trillion instead, because it looked better. But the real figure doesn't change overnight; it's still the same figure. And of course, a lot of these derivatives, you have to remember, most of them are over the counter. They're not on an exchange. They are in off-balance sheet vehicles, and often in a way that you don't actually even need to report on them. Again, coming back to Archegos, they had these contracts for difference. All of these positions that now hedge funds take, or that these investment bank take, they're all in derivatives basically, and they can deal with derivatives in a way that it doesn't show up when you're looking at over the counter derivatives in special vehicles, etc., special purpose vehicles outside of their main balance sheet. So therefore, we don't know what the exposure is. I mean, I have sources that tell me that the exposure is more than 1.5 quadrillion. It's over 2 trillion. I can't prove it, so I don't know. But it wouldn't surprise me that it's grown to that extent. It's an incredibly profitable industry for this investment banks, the derivatives. But you have to remember that derivatives work when everybody's buying them, i.e. investors are buying them, banks can issue them, etc. But when the market turns and people want to get out of these derivatives, as we saw again in the Archegos example, then there's no liquidity, and there's no takers on the other side, and therefore they will just implode. There's nothing there. There's nothing. There's just paper. There's no underlying asset whatsoever. That's going to be the problem.
Egon, throughout my schooling life and education, the subject of maths was never a brilliant subject for me. I struggled. I passed, but I struggled. And I suppose what I'm leading to here is that, yeah, the derivatives factor, I'd like to talk about that in a minute. But one thing I got out of arithmetic and maths is that when you hold something in your hand, gold or silver, and if you believe it's money, right, there is no other such thing as could be money or maybe money. And that's why in 1997, Darryl and I, we came across a gentleman, and everybody's heard the story, but in 1997, we started to save in gold and silver because we could touch it, feel it, anything that we couldn't do that on, we left it alone. And, we've been doing this for 21, 22 years, 24 years now. And remarkably, it has done very well for us. We have never really looked back. No. The word derivative comes up so many times, Egon. Can I ask you a question? Can you explain to us or the audience what the difference is between gross and net derivatives?
So coming back to well, first of all, of course, the word derivatives, it derives from the real product. So this is a derivative is a synthetic piece of paper, if you want, based on some underlying asset. It can be in the stock market, can be in the interest market, can be in the currency market, can be in the gold market, silver market. And so these bankers came up with a beautiful instrument as far as they're concerned, because they could trade and issue any security in the form of paper without even ever owning the security. Sure, sometimes they back it up with owning part of the security or with a massive leverage, but basically they can construct these instruments without ever having the security itself. So that is a con in itself. And as I said, that's what not all of the 1.5 quadrillion is based on that, but a major part of. So the world has created an illusory market now in securities, which has no underlying securities. So there is pure speculation, basically. So that is a derivative. That's what a derivative is. Now, coming back to what was your question about
the difference between gross and net?
So that coming back, yes, again to Deutsche Bank, and so Deutsche Bank basically has these 40 plus trillion derivatives gross. Now, of course, the banks issue a lot of these positions. There's only let's say maximum 10 banks that are in that big league of derivatives. All the smaller banks do it too, but that doesn't really count. So let's say it's 10 numbers. My figure 10 is arbitrary, but let's say there is 10 to maximum 15 big banks that do this. And of course, so they have a number of positions between them, with different different values, different maturities, etc. And so the 40 is the growth of all the banks, and then, as I said, 40 trillion, and then like in Deutsche, they take it down. As I said, they say that the real risk is only 20 billion. And then they net off everything against everybody and assume that everybody pays and that every position is the same as another position, regardless of maturities, etc. So they net it off, and then hocus pocus, it becomes 40 trillion becomes 20 billion. Wonderful. Then there's no risk at all. But then all of a sudden an archegos happens, and all of a sudden the whole position blows up in their face.
Yeah.
So that's what we're going to see, I think. So therefore, that this is to me, this market is a massive con. I understand it's beautiful instrument for the investment banks to deal in, just dealing in paper without any underlying security and making money on the growth that they issue. It's fantastic. And then only counting the net as their real risk. It's a money spinner, of course, but it's a money spinner that will spin out of control. That's the problem.
You've just mentioned it, Archegos. From what I've read, is about a $30 billion loss. Also, in the last month, there's another company, Credit Suisse. Everybody's heard of Credit Suisse. They through Greensill Capital, which, by the way, was part of an Australian farmer or a startup organisation, Greensill Capital. But anyway, just recently lost Credit Suisse. They recently lost $3 billion. Now, this is in the last month. Do you think this might be the snowball that starts the roll on, or will we see more of these things more regularly, and then the balloon pops?
I mean, Credit Suisse is just a good example, but I think most of these banks are in the same position. They're all writing off or paying fines of billions today. 20 years ago, a billion would have absolutely ruined or bankrupted the whole system. Yeah. And now it's just like chicken feed. But how can Credit Suisse? They lost. A few years earlier, they lost on mortgage mis-selling of mortgage securities. They had to pay a fine of whatever it was, $5 billion in the US, and it's gone on like that. How much? Is it incompetence or is it bad luck? It's certainly nothing to do with bad luck whatsoever. It's incompetence and it's greed. These banks are now in a league. They're playing in a league that they don't understand themselves. And as I said before, the board doesn't understand these positions. The top management doesn't understand the positions. And the traders construct these and they can get, by showing that the net exposure is very small, which I said is a con, because it is actually the net, the gross remains gross when counterparty doesn't pay, as we said before, and therefore it's a system based on just air. All of these derivatives, we will see when these markets start going down, and all of a sudden people need to get out of derivatives, and there is nobody there on the other side to pay for their side. Then we will see that this whole thing can implode very quickly, and therefore it's the highest level of greed combined with also an incredible incompetence and mismanagement by the banks, because we know that the upside, all these profits, all these all the gains on all of these instruments, that is privatized. That goes to very little to shareholders, most of it to management, to traders, etc., and bonuses. And I often take the example of 2008 when all the banks were few hours or few minutes from bankruptcy. All the major, Morgan Stanley, JP Morgan, etc., Goldman Sachs, they were virtually bankrupt, but they were saved again by central banks because they felt they had no option. But that year, the management and the employees had got the same in these banks, got the same bonuses as the year before. It shows you that this is, I know it. And it shows you there's a sick system. And as I said, all the gains are privatized, goes to the management and a little bit to shareholders, and the losses they're socialized. They go to either the shareholders, the depositors, or taxpayers. So this is a system that is not tenable, and we will see in the next few years what the outcome will be when all of this just blows up or implodes.
Yeah, it's you can see it's bubbling away, and I feel we don't have too much longer in respect to months or 12 months, 2 years, absolute max. In the meantime, at least there's one positive thing, that if it doesn't blow up for 2 years, you've got some time to buy silver and gold, because that's what Darryl and I are doing. I'm going to continue on, not on the subject of derivatives, but on the subject of the GDP debt. Was listening to Alistair MacLeod from The Economist out of England. Alistair was saying, he commented that the world GDP is presently around the 80 trillion US dollars, but the debt to GDP is 355%. He summarised it in another way, and he said it takes $3.55 of debt to produce $1 increase in the GDP. Now, my mathematics, as I said, my mathematics wasn't good, but I can tell you that I think there's something wrong with the system that has to have a growth of $3.55 to get $1 of growth. Can you talk about this? Can you add your comments to this, Egon?
I've been talking about this for a while, and of course, you get into a vicious circle that when you have fake markets and fake money and fake economy and fake GDP figures, in order to maintain this, you have to print ever more money to achieve an increase in growth. We haven't had real growth for years and years. I mean, you can look at shadow statistics, for example, and you will see that GDP is actually going down rather than up if you inflation adjust it or based on proper inflation. So all of the figures we are seeing are just based on printing more and more fake money, because it isn't real money that has no underlying value, has not required any work, any service, any production of anything to actually issue. That money by definition must be fake, and therefore the assets that this money is buying, whether it's a house in Australia or a Tesla or Bitcoin or whatever it is, most of those assets are also, they're not fake, but they're massively overvalued because it's based on money that actually has no value. And that's the dilemma that the world has, that you just got to continue to print this money without stopping, because the day you stop, it's going to implode overnight, basically. And of course, there's no worry today from the money printing point of view, because we're seeing more money printed and more credit issued than ever right now. The Biden started with his 2 trillion package, and then there's the infrastructure package, which might be 4 trillion, et cetera, et cetera. It'll never end. And I forecast when Trump was elected, when Obama handed over a 20 trillion debt to him, I forecast that after when Trump's first period was over, that the debt would be 28 trillion, and then 4 years later, which is now Biden's period, it would be 40 trillion the US debt. Of course, nobody believed those figures at the time, but I just, as I often do, I just based it on history. I just went back I only went back to 1981 with Reagan, but on average, US debt has doubled every 8 years since Reagan. I think you can go back further and find the same. So, so I just did a very simple extrapolation, but of course, nobody believes it when you get into bigger figures. It's not possible that the debt can go from 20 trillion when Obama handed over to Trump, and then to 40 trillion 8 years later. Well, we are there, and I actually looking at it now, that 40 trillion is looking low. I think it could be 50 trillion even. So right now, in 4 years' time, and the way Biden is going, there'll be no problem, and because he's borrowing hand over fist, and the deficits are going to increase. So it's very simple, and all of that is still based on no problems in financial markets, no major losses in the banking system, etc. And you can imagine what will happen then if they need to start to print money for that too. So the money printing will continue. The currency debasement will continue and accelerate, of course. And at some point, there's a risk that this whole thing will blow up. I hope it won't happen, because the consequences will be dire for the world, but I don't see any solution. We all know that you cannot solve a debt problem by more debt, but that's the only tool that central banks and governments have. And that's the only thing they will do. There is no question of anyone starting austerity or cutting down on expenses or cutting deficits. Nobody even dares to think about that, and especially now with the consequences of the coronavirus. Because now, on the other hand, everybody thinks that coming out of the coronavirus, the market's going to boom and the economy is going to boom. It might do for 3 months or so, but then the whole question of the debt, the asset bubbles, etc., will hit markets, and they will turn. They always turn, as we said. Well, people don't expect it. They always turn at the top, never at the. They never turn down at the bottom. They always turn down at the top. And we are at extreme tops now.
So, to sum that one up, it's really the only growth we can expect in the near future is debt growth, not real growth. Darryl?
Oh yeah, well, you can fully count on that.
Yeah, the debt growth, makes the impression that it actually creates GDP growth and economic growth, but it isn't real, as we just said.
Yeah.
Egon, in Australia, we have a silver shortage with some major suppliers. We have not had an issue. We've got a regular supply, and we've been able to provide ongoing support there for all of our clients. But just recently, John Adams, our chief economist, exposed a number of companies so far as their ability to supply physical metal. I'd just like to share this story with you for a moment. We've not been able to source, that is, as good as Gold Australia has not been able to source physical metal. I'm talking silver, 1 kilo, 10 ounce, 100 ounce bars for the last couple of months. So at this stage, the Perth Mint can't supply distributors. They can supply in some cases at retail, but it's in limited supply. So, but what sort of triggered this whole thing off was a request by a number of people who were clients of the Perth Mint who were holding unallocated, pool allocated silver. And they heard of the shortage and wanted to have their positions exchanged. They wanted to take physical possession of the metal, only to be told that it wasn't available to them. Now, on the contract with the Perth Mint, they clearly state that if you're in an unallocated or pool allocated position and you want to take delivery of physical metal, it's a 10-day supply or guarantee, a 10-day period. But many clients found this not to be the case. They were told that they couldn't receive it, or that they would have to wait considerably longer, or that they would have to wait in a queue, and the queue was pretty deep. So a lot of them have decided to cash in. They've liquidated their positions, and they've purchased physical metal from other suppliers who made it available. Now, my question to you is this: if this, and I believe in the United States that this is quite similar, that there is a huge demand on silver and there is a supply problem. Now, if this develops and really grows, and a mass number of people decide that they want to exchange or change their position from, say, synthetic to physical metal, I'm thinking that this could place the silver market or expose the limited supply, and that could in fact force prices to a very escalated level. What are your thoughts there?
The Perth Mint sadly has a history of not being able to deliver metals when there is high demand in the market. We don't deal with them, so I can't tell you from more than indirect experience, but I remember that there were lots of rumors around the great financial crisis, 6, 7, 8, that the Perth Mint actually, because at that time there was also high demand for gold and silver, and the Perth Mint actually, it could take up to 6 months to get delivery from them at that time. I remember it clearly, now, and of course, they had to issue statements even on their website to shareholders that the situation was sound and there was no problem. But there was clearly a problem, because anyone who issues paper contracts of any metals without underlying metals to back it straight away, as I said, they run the risk of this. Is never. It does so far. It hasn't happened on COMEX on the futures exchanges. But once we get the real fear that there isn't enough physical gold or silver available, it will be the same on those exchanges. So the Perth Mint clearly issues too many certificates which are uncovered by physical, and then they hope to produce it in the future. And when the demand increases, they then have massive delays. So I'm not surprised, because that's sadly the history to some extent. Of course, we read about now that especially silver, retail silver, there's a massive shortage, especially in the US and in other countries. And you've been looking at spreads being being up 50% higher than spot, etc. You've been looking at prices. Now I have to add that is in the retail market. So far, and we're only buying the big investment bars. We're buying the 1,000-ounce bars and or 30 kilos, and those we have no problem sourcing these bars. Either from refiners in Switzerland, or the Swiss refiners are not major producers of silver, we have to say, but that is really a byproduct of their gold productions. Nevertheless, they do refine silver. But we deal with bullion banks that have access to silver without any problem, and they say there is no shortage. I think the fact that there is no shortage is not that there is enough silver to cover all the outstanding commitment, because we all know that definitely isn't, and Perth Mint is a good example of that. But if you then go to the LBMA banks or the COMEX, etc., they clearly don't have a fraction of the physical available for their paper contracts. So what you are saying is happening in Australia with the Perth Mint, and that that is why you and we have always said, never ever buy paper metals. Don't have your direct possession personally of your metals, that you can touch them, see them, and go to the vault wherever they are to actually take physical possession if you want to, or at least check that they're there. That is the only way for investors to buy metals. Physical in their own, I'm going to say, when I say under their own control, it doesn't have to be at home, because I don't believe in storing metals at home. You shouldn't store more at home than you can afford to lose, in my view. Very dangerous, especially if times get a lot more troublesome, which we expect. Then you shouldn't have them at home. Have them in safe vaults, well, Australia, Europe, Switzerland, where we are, etc. But have it in your own name, under your own control. That is absolutely essential. And having paper contracts with the Perth Mint, or with the COMEX, or with the bullion bank or whatever, doesn't fulfill those conditions which are vital. So coming back to your question, yes. So we have worldwide this as we discussed before, this incredible paper market. And this, of course, remember, we talked about derivatives. So these gold or silver certificates that the Perth Mint issues are also derivatives. They are derivatives without physical backing. Remember that, because as we said before, they're issuing these things, banks, mints clearly, without having the actual physical product behind it. And this is, since the Perth Mint can't deliver the silver, it means they don't have it. They hope under normal circumstances, under normal demand, to be able to refine the silver and deliver. But today they can't. As I said, there is, in the wholesale market at bigger levels, there is still silver available. But in my view, that is only available because the LBMA banks shuffle silver between themselves. So there's always, and they borrow and lease, etc. So that is, so they can manage to keep it all going. But if people would do like they do in Australia with the Perth Mint, if they actually start worrying about the fact that the silver might not be there and ask for delivery, there won't be any silver, of course, neither on COMEX nor with the LBMA. And that situation is going to come. I've been expecting it for a while. They managed to keep it going by massive daily trading on the LBMA in gold and silver, in volumes that are just difficult to fathom. But why they trade such? They trade two times the daily volume of the S&P, for example, for a market which is only half a percent, which is so small, and a fraction of world financial market. So but from what I understand, the BIS, the Bank of International Settlements, to help the bullion banks maintain their liquidity and their position, they're issuing swaps, which gives the bullion banks the supply in paper form that can keep the positions going. And then whatever physical is asked for, they as I said, they lend or lease to each other between them, because there isn't enough physical silver produced for this. As we see with the Perth Mint, there isn't enough produced to actually satisfy an increase in demand. So yes, this market will blow up one day. Again, I've been wrong on the timing. It's taken a lot longer than I expected. And it's amazing how these people can actually keep the illusion going. I mean, when I say these people, the BIS and the LBMA banks, etc., how can it die? They can keep it going. But the things that don't make sense will not last. It could last longer than we expect, but they're not going to last. So this whole market will blow up one day. There's no question about it. And then you will see, silver and gold prices, which will be hard to fathom. And that's just on the supply and demand side. And then we know with what we see in financial markets and with inflation, etc., of course, that will also put enormous upside pressure on prices. So overall, but again, we're back to we are not holding these metals, your company or our company we're not helping our clients in order to make lots of money. We're holding it in order for them to ensure their assets against the destruction of the financial system and the total debasement of currencies. That's what we're doing. I think the gain in these metals, which will be major. I mean, that's an additional bonus, but it will happen. But that's what they shouldn't hold it for that purpose. People should hold it to preserve their wealth.
Oh, you're 100% correct. I mean, I look at the reason I got into precious metals in the first place, and it was to reduce my exposure, reduce my risk. And the moment I consider, or if I consider a synthetic product, I've lost everything that I was attempting to gain in the first place. Makes no sense at all. So Brian's right. For 30 years, we've been investing in precious metals, and it's always been taking physical possession, hasn't it?
Yeah, exactly. Yeah. I mean, to our clients as good as gold, you can go looking as far as you possibly can on our website. You won't see pool allocated, unallocated. It is all in physical. So you either place an order, you receive the physical, or you vault the physical. That's the way we do business. Getting close to the end, Egon. Every day when and it's 7 days a week, when I switch on my computer in my office, I have a quote that just comes up, and it's one of the best quotes I've ever heard and see, and that's why I've got it on there. But it's from Ralph Waldo Emerson, The quote is, "The desire for gold is not for gold. It is for the means of freedom and benefit." What do you get out of that quote? What was Waldo Emerson talking about?
I have also used that quote in articles in the past, and it's a wonderful quote. And you know, this is what you just said about your gold holding, what you are telling your clients, what we are telling our clients. You know, gold is not greed. That's not why we're buying it to make money. And you know, we are both you and we are trying to tell investors that, you know, you buy gold at any time. Don't wait for the price to go up and you buy because it goes up. I mean, then you're buying gold for the wrong purpose. Buy it when it's low, buy it when it's down. I mean, like now we've had an 8 or what do we have, 5, 7, 8 months correction in gold now. You know, now is the time to buy it. We're coming to the end of that correction. Sure. Technically, I'm seeing that this, you know, I think we have turned already. And the next move will be a strong move again. Fundamentally, we know why. Technically, it looks very good. So, you know, buy, as Emerson said, buy gold for peace of mind and for freedom. Don't buy it because you want the price to go up. You're not buying a piece of yellow metal. And you're buying something which is so much more important. You're buying your own freedom. You're buying something that has, for 5,000 years, always has had eternal value, and has had over time stable purchasing power. And there's no other money that has achieved that. Every currency, as we both know, has gone to zero throughout history. But you know, gold can't be compared to fiat currencies because gold has stood the test of time. And you know, there are so many examples of people around the world, and I've seen it in my business life when people come from countries in oppressed countries, and they flee from oppressed countries, especially the Asians. You know, and they come with a bit of gold. That's the only thing they could smuggle out, could even be jewelry, and they start again. You know, I met a man from ex-Yugoslavia in a restaurant in the Italian part of Switzerland 6 months ago, and he was the owner of the restaurant. And he said, he saw me and he said, I recognize you. I know who you are. He said, which was a surprise when you get to a restaurant, you know, in the Italian part of Switzerland. And he said, you know, I've been through hyperinflation. You know, I've seen all my friends lost all of their money. I had some gold, and that's what saved me. And, you know, I was there with friends, and he told the friends, don't ever hold money in the bank. You know, have gold. And, you know, the people who have experienced a collapse of the system and a total debasement of currencies, like he had, you know, for him, there is no other money than gold. That's the only way to preserve your wealth. There are other investments that at different stages of history can be very good. But for wealth preservation and for money, you know, there is no alternative to gold and silver. And therefore, you know, coming back to Emerson, yes, it gives you freedom. And this is what exactly this man discovered. And this is, again, what I've experienced other people coming from oppressed countries and coming with gold. It gives them freedom. They can start again. And that's why, you know, it's such a simple thing. I mean, what you're doing, trying to help investors to preserve their wealth, and what we are doing exactly the same here. It's a very simple business, you know, and I mean, we are doing it out of passion because we clearly believe that people must be helped because and be insured against what's going to happen. And so therefore we have a straightforward business, no complications. You own the gold, you own the silver, no paper, no derivatives. And that's what people need today. And you are providing a fantastic service, and we're doing the same all over the world. I hope that more people will realize this, and that people will understand that the need for freedom, as Emerson said, is now greater than ever, because we are not going to get that freedom with paper money. That's for certain.
No.
Yeah.
Very well said, Egon, and I couldn't have said it any better. So that's fantastic.
You definitely couldn't have said
no,
it
I
any
definitely
better.
couldn't say it any better. No.
An absolute wealth of knowledge, Egon. And look, it's I've got to say, and I am repeating myself every time we chat in an interview, it's an absolute privilege to be able to do that, and for you to be so receptive whenever we ask. If you've got a moment, you don't hesitate and put your hand up and say, sure, no problem at all. So very, very appreciative at this end. I would like to highlight, of course, to our viewing audience that Matterhorn Asset Management and of course, GoldSwitzerland. Can you just explain to our audience exactly what you do? I know that Matterhorn Asset Management is the biggest private vault in the world, which is spectacular. Could you just tell us a little bit more about what you do?
So the name of the company is Matterhorn Asset Management. I've always had a love for the Matterhorn, which is in the village of Zermatt, where I've spent more time than usual this year because of lockdowns, etc. And I'm there right now, and I have, although this is not my view here, I mean, this is a virtual picture behind me, but nevertheless, I have that view out of my window. It's a wonderful mountain, and it's a beautiful area all year around. So that's why the company is called Matterhorn Asset Management, which I founded end of the 90s. And then we added the URL. Our website is called GoldSwitzerland.com for the simple reason that that's easy to find. But the name of the company is Matterhorn Asset Management, or MAM as we often call it. So what we do is to help people all around the world to preserve wealth. We cater for, because that's our skill. Basically, we cater for bigger investors. So in our vaults in Zurich or in Singapore, for our minimum is $400,000, and in our mountain vault in the Swiss Alps, it's not in the Matterhorn, it's another mountain. There, our minimum is $5 million. So we cater for bigger investors, and some people say, it's unfair. Why can't you help us? It's just that we have a structure and that really caters for the bigger investors, because we give a high level of personal service and advice, and a very high level of security. So this is what we do for countries, for people in around 80 countries in the world. And as I said, for me, I'm at a later stage of my life, way past retirement. But for me, it's a passion, and I have no plans of giving up. And because this is we'd like to help as many people as possible. Of course, I have a good team behind me, or like for example, Matt Pipenberger, as you mentioned, but we have several people behind who are there to service our clients. So, and I think it's a people's business. With you, I can see why people. It's all about trust. People, this business is so important. Your trust is something that is very hard and hard to earn, and very difficult, or very easy to lose. But that's why it's all based on integrity, honesty, obviously. And I've been in business a long time, and so have you. And I think I can see how you inspire confidence in your clients and investors, and I know we do too. And that's for us. That's our passion, and that's what we would like to continue to do. We both know that this market, the way we see the world, the precious metals, that investment in precious metals, as they are in gold, only 0.5% of world financial assets. That it's just only started. People will soon start buy metals to an extent that you didn't think was possible. But of course, as you just said with the Perth Mint, or as we know also with gold, there isn't enough stock to satisfy all the gold and silver that's produced today is being consumed or bought. And therefore, there are no excess stocks anywhere. Central banks probably have a lot less stock than they say they have. The 33,000 tons they say they have, there's probably a lot less because they've leased it out or sold it covertly. And therefore, there won't be more gold, there won't be more silver, except for very small amounts of annual production. And therefore, the only way that people can buy gold and silver today or in the future will be at higher prices. So, if you intend to invest $100,000 in gold today, you get what, a kilo and a half basically for $100,000, a bit more than a kilo and a half US dollars, and tomorrow you might get 100 grams or a tenth of it for 100,000. That's what's going to happen. That's the only way you can adjust the lack of supply. It's only in price, and therefore that you will see a price adjustment that few people will believe, because that's the only way that more investors can get into the precious metals market. And that's when we really understand why it's called precious metals. They will be extremely precious because there won't be enough of them. It's only at higher prices people can buy it. So that's why we are telling people, buy now when nobody wants it. You buy an asset which has a value, when it's undervalued and unloved, which is the case today. Buy it now. That's like we did in 2002. And then you just sit in it for generations if you can afford it.
Yep. Look, well, thank you. Just powerful advice. And I'd like to finish by saying or quoting one of Egon's famous quotes.
Wow.
Upon being asked the question, how much should I invest in precious metals? Egon's quote goes like this: whatever you can't afford to lose, I think is a really powerful statement.
Spot on. Yeah.
Right now, it becomes even more valid, doesn't it, than ever before. Egon, thank you so much for your input this evening. Like, we love interviewing you, and we call you a friend because we know you are. So we just look forward to catching up. And again, when the world gets back on its feet again and we can travel from A to B, who knows whether we get to you first and we travel to Switzerland or you come back to Australia, but it will be a great moment. When we catch up again. To our viewers and subscribers, thank you also for supporting our channel. We really appreciate your support. And so all I could say at this point is, until next time, stay well, stay focused, and goodbye for now.
Goodbye for now.